The median five-year-old American has saved $87,000 for retirement. Not the reckless ones, not the guy who leased a Porsche on a teacher's salary, or the couple who treated their home equity like an ATM to fund 3 kitchen renovations. The median, half of this country sits below that number. But here is the part nobody at your brokerage wants to say out loud. The people with $400,000, $600,000, even $800,000 saved. Most of them are also quietly going broke in slow motion. They just won't find out until they're 69 years old, staring at a portfolio statement that's falling faster than they ever modeled, with no earning window left to recover. The system didn't fail them dramatically. No crash, no scandal, no one stole their money. It failed them through 4 specific, invisible, mechanical processes that are entirely legal, widely practiced, and almost never explained by anyone with a financial incentive to explain them. This video is about those 4 processes, with real numbers, because vague financial anxiety is useless. Knowing exactly which hole is draining your tire that's useful? I said tire. Let me come back to that. By the way, I built a free retirement stress test calculator. Not the kind that shows you a smooth line going up forever. The kind that actually breaks your plan in the specific ways plans break. It uses the same methodology as BlackRock and Vanguard's research units, not the optimistic assumptions in your HR portal. Link is in the description. I only ask for your email to send the report. Now, the metaphor. Picture a slow puncture, not a blowout. A blowout you notice immediately you pull over, you deal with it. The damage is visible and contained. A slow puncture is different. The pressure drops 3 or 4 pounds per square inches every few weeks. The car feels completely normal. The steering responds perfectly. Your quarterly 401k statement arrives and the number is higher than last quarter, so you feel fine. You keep driving. And then one Tuesday morning, you walk out to the driveway and the tire is completely, visibly flat. Your first thought, when did that happen? The real answer, it was always happening. You just couldn't feel it. That is your retirement savings between ages 32 and 58. The pressure bleeds out slowly, invisibly, through fees, through inflation math, through a timing risk most people have never heard named, and through a healthcare number that is going to make you briefly want to close this tab. Stay with me, because the tire does not have to go flat. The point of finding the holes is that holes can be patched. I'm going to show you all 4, and I'm going to give you 3 specific, boring, actually effective things to do about them. Not generic advice, the specific version. Let's start with the hole that almost no mainstream financial media ever bothers to name. 2 people. Call them Daniel and Victor. Same age, 65. Same portfolio, $500,000. Same plan, withdraw $22,000 per year, which combined with Social Security gives them a livable income. Same fund, a broadly diversified equity portfolio that over the next 30 years will average exactly 7% annually. Same average, same everything, except one thing. Daniel retires into a bull market. His first 5 years look like this: plus 11%, plus 9%, plus 13%, plus 7%, plus 10%. The portfolio grows while he withdraws from it. By year 5, despite pulling $22,000 per year out, his balance is actually higher than when he started. Victor retires into the 2008 financial crisis, the same crisis that wiped out $8 trillion in American household wealth in 18 months. His first 3 years, negative 38%, negative 12%, plus 4%. Victor's portfolio has lost nearly half its value in 36 months. And Victor is still withdrawing $22,000 per year because his mortgage doesn't care what the S&P 500 is doing. He's not selling equities because he wants to. He's selling because he has to eat. Those shares sold at the bottom of a crisis are permanently gone. They cannot recover for Victor because Victor no longer owns them. When the market rebounds in years 4 and 5, Victor has dramatically fewer shares to benefit from that recovery. Fast forward 30 years, same average annual return, same starting balance, same withdrawal rate. Daniel finishes with approximately $1.4 million. Victor runs out of money entirely at age 79. Not because Victor was less disciplined, not because he made worse investment choices, because of what the market did in the first 36 months of his retirement, something he had zero control over. This is called sequence of returns risk. This is the first hole in the tire. And here is the reversal I want to deliver directly. You think the retirement problem is about how much you save. Every financial advice article, every HR presentation, every automated email from your 401k provider is aimed at that one message. Save more. Max your contributions. Automate the increases. That advice is not wrong, but it is so incomplete it becomes dangerously misleading. Because the timing of when the market has a bad year relative to when you retire is a variable with enormous consequences, and it receives almost no coverage in the standard retirement planning conversation. You can save perfectly for 33 years and still run out of money because you retired into the wrong 3-6-month window. I watched this happen to a man I'll call Richard. Real situation. Changed name. The math is accurate. Richard spent 31 years as a senior operations manager at a logistics company in Ohio. He contributed consistently to his employer plan, owned his home outright by 61, carried no consumer debt. By October 2007, at age 63, he had $710,000 saved, a solid number by any measure. He retired in November 2007. There was a dinner, a gold watch, people made speeches. You know what came next. The 2008 financial crisis. Lehman Brothers collapsed in September 2008. The S&P 500 fell 57% from peak to trough. Richard's portfolio was cut by approximately 44%. $710,000 became roughly $398,000. And because Richard was no longer working, he had to draw $28,000 per year from that depleted number just to cover living costs, a mortgage payment he still had, utilities, food, basic healthcare copays. He was selling equities at their absolute lowest prices to fund groceries. The market recovered by 2010. The recovery was real. But Richard had sold so many shares at the bottom that he owned far fewer of them to benefit from the rebound. By 2013, Richard had less saved than he had at age 58. He went back to work part-time at 69, not because retirement bored him, because the tire had gone flat on the first day of the drive and nobody had ever shown him where the spare was kept. Richard did everything right. He had one bad exit window. That is the slow puncture nobody explained. The solution to this specific problem has existed for decades. It is called the bucket strategy, or more formally, liability matching. You structure your retirement assets into 3 distinct buckets before you retire. Bucket 1. 1 to 3 years of living expenses in cash or very short-term treasury securities. This is what you live on. You never sell equities to fund daily life, especially not during a market downturn. In 2026, high-yield savings accounts and 6-month T-bills are paying 4.3% to 4.7%. This is not dead money. It's liquid, earning a real return, and protecting you from exactly the scenario that destroyed Richard's retirement on day 1. Bucket 2. 3 to 10 years of moderate growth assets, balanced funds, intermediate duration bonds. Anything that doesn't crater 40% in a single bad year. This is your refill mechanism. Bucket 3. Your long-term equity portfolio. You don't touch it for at least a decade. When the market crashes in year 1 of your retirement, you live off Bucket 1. The equities in Bucket 3 have time to recover. You refill Bucket 1 from Bucket 2 when the storm passes. This is not complicated. William Bernstein wrote about it extensively. Vanguard uses elements of it in their own retirement income research. Christine Benz at Morningstar has published more than 40 articles on bucket implementation. The backtesting is extensive. The logic is airtight. And yet look at the default options in your employer-sponsored retirement plan. There is no bucket structure. There is a target date fund. There is a smooth line projected to go up and to the right. And there is an expense ratio quietly draining pressure from the tire every single year. Which brings us to the second hole. Here is a number I want you to actually write down. $200,000 invested today, earning an average of 7% per year over 30 years. No fees, just compounding. You end up with approximately $1,522,000. Now, add an annual expense ratio of 1.2%. That is not extreme. That is the documented average expense ratio for actively managed mutual funds inside employer-sponsored retirement plans, according to Morningstar's 2024 fund fee study. Your net return drops to 5.8%, same 30 years, same starting amount. You end up with approximately $1,148,000. The difference is $374,000. Nearly $374,000 paid to a fund manager for the privilege of statistically underperforming a basic index fund. According to the S&P SPIVA report, which tracks active fund performance against benchmarks every 6 months, approximately 83% of large-cap actively managed funds underperform the S&P 500 over a 1-5-year period. Not occasionally, not in bad years. Structurally, consistently. Across every 1-5-year rolling window they've measured. The fee is a mathematical headwind that compounds in the wrong direction for as long as you hold the fund. Now here is the part that should genuinely make you angry. The default fund allocation in your 401 KEC is not the cheapest option available to you. It is the option that was easiest for the plan administrator to justify, and in many cases, the fund company paid for that placement. This is called revenue sharing. It is legal. It is documented. A fund pays a fee to be included as a default option in your employer's retirement plan. Your financial advisor, meanwhile, may not be legally required to disclose any of this. The fiduciary standard, the rule that requires advisors to act in your best interest, applies to some advisors, not others. An advisor operating under the looser suitability standard only needs to recommend something suitable, not optimal, not cheapest, not mathematically best, for your specific life, suitable, which is a bar set, approximately as high as you'd expect it to be, given who spent $300 million lobbying to keep it that low. I want to be precise here. The financial services industry is not full of villains. It's full of people responding rationally to incentive structures. The advisor earns more when you're in a higher fee product. So the path of least resistance and the most marketed path is higher fee products. This is as surprising as discovering that a casino is architecturally designed to make you lose track of time. The tire has 2 holes now: sequence, risk, and fee drag. Each is manageable in isolation. Together, they have quietly destroyed the retirement plans of an enormous number of people who saved responsibly and assumed the system was working in their favor. But stay with me, because this next part changes the entire shape of the problem. The inflation math, specifically the gap between what people think their retirement will cost and what it will actually cost, is the third hole. 3% annual inflation doesn't sound alarming. Here is what 3% does, compounded over time. At 3% annually, prices double in roughly 24 years. So if you retire at 65 and you're planning to live to 90, which is not an unrealistic horizon for someone in reasonable health, the Social Security Administration's own actuarial tables show that a 5-year-old woman today has a 50% chance of living past 86. The lifestyle that costs $65,000 per year today will cost approximately $129,000 per year when you're 89. Not because you upgraded your lifestyle, because the dollar got weaker while you were watching. Here's the version of this math most people have never run for themselves. The 4% withdrawal rule, the classic retirement planning heuristic developed by financial researcher William Bengen based on historical data through 1,994, says you can withdraw 4% of your portfolio annually. And it will, in historical simulations, last 30 years. Morningstar's updated 2024 research suggests that in the current interest rate and valuation environment, a more realistic safe withdrawal rate is closer to 3.3%. That doesn't sound like a big difference. On a $500,000 portfolio, the difference between 4% and 3.3% is $3,500 per year in sustainable income. Over 20 years, that is $70,000 your original plan assumed you had. The updated math says you probably don't. There's a joke told inside every financial planning office in America, and it goes like this. The advisor pulls up the projection. The line goes smoothly up and to the right. The client says, "So I'm going to be fine." The advisor says, "Based on our assumptions." The client says, "Great." Nobody asks what the assumptions are. Because the assumptions are constant returns, no bad sequences, inflation running exactly at target, and that the client dies at a statistically convenient age. The model is beautiful as long as nothing unexpected ever happens. Which is funny, given that the entire purpose of a financial plan is to handle the unexpected. And then there's Social Security, which most people count on as the inflation hedge in their retirement plan. The cost of living adjustments to Social Security are calculated using the Consumer Price Index for urban wage earners. But retirees don't spend money like urban wage earners. Retirees spend a substantially larger proportion of their income on healthcare and housing, both of which inflate significantly faster than general CPI. The Senior Citizens League tracked this discrepancy over 23 years. Their finding, Social Security benefits lost approximately 36% of their purchasing power between 2000 and 2023. Even with the annual adjustments included, your Social Security check went up every single year and still bought 36% less in real terms over that period. 3 holes: sequence risk, fee drag, inflation erosion. I promised you a kicker. Here it is. This next one is the one that makes the spare tire also flat. Healthcare. Fidelity's 2024 estimate for out-of-pocket healthcare costs for a 5-year old couple retiring today. $315,000 over the course of retirement. That is after Medicare. That is not counting long-term care. That is baseline, boring, routine healthcare premiums, deductibles, prescriptions, dental, vision, hearing. The unavoidable costs of an aging body in a country where medical inflation has run at approximately 5.5% annually for 2 decades. But the number that receives almost no attention is the gap year cost. If you want to retire before 65, and Gallup surveys consistently show that most Americans want to retire between 60 and 62, you lose employer-sponsored health insurance. Medicare doesn't begin until 65. For a couple in their late 50s, in 2026, a comprehensive private health plan on the ACA marketplace runs between $24,000 and $32,000 per year in premiums alone. Before anything goes wrong medically, before deductibles, before prescriptions. $24,000 to $32,000 annually at the exact moment you've stopped generating income and started drawing down savings. This is the structural reason the actual median retirement age in America is 62, despite most people wanting to leave sooner. The 3-year healthcare gap keeps people employed not because they love their jobs, but because the cost of leaving is a number that looks like a car payment plus a mortgage payment, and it recurs every single month. Richard, the logistics manager from 2007, had one more chapter. At age 68, his wife had a cardiac event. Not immediately life-threatening, but it required hospitalization, a procedure, 2 follow-up surgeries, and extended rehabilitation. Their out-of-pocket costs for that year? Approximately $22,000. Not a catastrophic number in isolation, but added to a portfolio already gutted by the 2008 drawdown, already grinding through annual withdrawals with insufficient recovery, it was the event that pushed their annual depletion rate into permanently dangerous territory. It wasn't the stock market that ultimately broke Richard's retirement plan, it was a medical bill. A predictable, statistically inevitable medical bill that the original plan with its smooth upward line had no room for. because the plan had no human body in it. I want to stop here for a moment, because I think this story deserves a harder edge than most financial content is willing to give it. In 2012, a series of investigations revealed that several major pension funds, including funds managing public sector retirement savings for teachers, police officers, and municipal employees, had been paying dramatically inflated fees to investment managers through arrangements that were never disclosed to fund participants. In one documented case, the City of San Jose's pension fund was paying a private equity firm 2.1% annual fees plus 20% carried interest arrangements that transferred hundreds of millions of dollars from teachers' retirement accounts to fund managers' personal accounts over a decade. The retirees didn't know. The fees were buried in fund-of-funds structures designed to be opaque. The people who set up those arrangements, they moved on to other positions. Some became consultants to other pension funds. This is not ancient history. The SEC's 2020 examination of private equity fund fees found that 63% of funds examined had fee and expense issues, including undisclosed fees and conflicts of interest. 63%. This is not a conspiracy. Nobody broke into your account. What happened was entirely legal. Structures were designed so that the people choosing your investment options had financial incentives that ran in a different direction than yours. The result was the same as if someone had been quietly stealing from you. Slower, more paperwork, completely legitimate. And here is the part that actually makes it a scandal. The people whose retirement money was being drained were doing everything right. They were contributing every paycheck. They trusted the system. The system had a different agenda. Now, the framework. 3 levels. Specific, in order of urgency. Level 1, fee surgery. This week, not eventually. Open your 401 KEC, your IRA, your brokerage. Find the expense ratio on every fund you own. Most platforms display it directly on the fund profile page. If anything is above 0.2%, you have a live leak. If anything is above 0.5% and it's actively managed, you are almost certainly paying for underperformance while compounding works against you. Vanguard's Total Stock Market Index Fund, 0.03% annually. Fidelity's Zero Total Market Index Fund, 0%, literally zero. Switching from a 1% expense ratio to a 0.03% expense ratio on a $200,000 portfolio over 25 years is worth approximately $180,000 in recaptured compounding. You don't need to become a trader to capture that gain. You need to open a tab, find the fund, and change the allocation. It will take less time than watching this video took. Level 2. Inflation adjust your retirement number. Take whatever target number you currently have in your head, $1 million, $1.5 million, whatever the figure is, and run it forward at 3% annually for each year until you plan to retire. Then, run your expected annual expenses forward at the same 3%. The gap between your inflation-adjusted expense needs and your portfolio's actual sustainable withdrawal capacity is your real shortfall. Most people set their retirement target once, years ago, based on a conversation with someone at HR or a financial planner running an optimistic projection. They haven't revisited it since. The target sits there, getting more wrong every year, while the balance going up on the statement creates a false sense of security. Level 3. Build the buckets before you need them. You do not have to be 64 to start thinking this way. If you're in your 40s or 50s, this means keeping 1 to 2 years of living expenses, call it $45,000 to $90,000, depending on your lifestyle, in a high-yield savings account or a short-term treasury. Ladder, separate from your investment accounts, not in equities, accessible within days. This is not dead money. High-yield savings accounts in 2026 are paying approximately 4.2% to 4.6% annually. You're earning a real return while also buying protection against the exact sequence of return scenario that ended Richard's retirement on its first day. The bucket is the shock absorber. It is the difference between being Daniel and being Victor when the market decides to have a bad year the same month you stop working. Let me make this concrete so it stops being abstract. Sarah, 46 years old, HR director at a mid-size manufacturing company in Columbus, Ohio, $82,000 per year, has $175,000 in her 401 KEK. She set her contribution allocation in 2015 when she first enrolled and hasn't looked at it since. She doesn't know her expense ratios. She checks her balance periodically, sees it going up, and assumes everything is fine. Sarah's current fund mix averages about 0.91% in annual fees. If she switched entirely to the lowest cost option available in her plan, and there is almost certainly a low-cost index option there, because federal regulations now require plans to offer at least one, she could cut that to approximately 0.04%. The difference of 0.87% annually on a growing balance over 19 years until her planned retirement adds up to roughly $94,000 in recaptured compounding. $94,000 just from spending 40 minutes changing a fund selection she made in 2015. Beyond the fees. Sarah plans to retire at 65. She currently spends $58,000 per year. At 3% annual inflation over 19 years, her lifestyle will cost approximately $101,000 annually in nominal terms when she retires. If she stays on her current savings trajectory without any changes, she'll have about $490,000 saved. A 3.3% sustainable withdrawal rate gives her $16,170 per year from the portfolio. Her Social Security benefit at 65, 2 years before her full retirement age, meaning a permanently reduced benefit, works out to roughly $20,400 annually based on her earnings history. Combined, $36,570 per year. She needs $101,000. There is a $64,430 annual gap between what Sarah's plan produces and what Sarah's life will actually cost. That gap doesn't close by working one extra year. It requires a higher savings rate now, fee reduction, Social Security optimization, potentially delaying her claim to 70, which increases benefits by 32% compared to claiming at 67, and a genuine conversation about what 65 retirement actually looks like given the math, versus whether 68 with a slightly adjusted lifestyle might be the trade that actually works. None of those conversations are difficult. All of them require Sarah to look directly at numbers. The system has no incentive to show her clearly. The tire has been losing pressure since 2015. The balance going up on the screen masks the leak. She has 19 years left. The math is fixable, but not if she never finds the holes. One more thing before the close, because I think you've earned a moment of absurdist clarity. There's a product called a target date retirement fund. The pitch is elegant. You pick a year, say 2040, and the fund automatically shifts its asset allocation as you approach that date. More equities when you're young, more bonds as you near retirement. Set it and forget it. The fund manages the risk, so you don't have to. Brilliant, right? Except the fund adjusts based on your target date, not your sequence of returns risk. It doesn't know if the market is going to crater the same quarter you retire. It doesn't build the 3-bucket structure. It doesn't model your personal healthcare costs or your specific inflation exposure. And it charges, on average, about 15 to 20 basis points more than a simple 2-fund portfolio of equivalent index funds. The target date fund is the GPS that always suggests the highway route without ever checking traffic. It will probably get you there if nothing unexpected happens, which is a very low bar for a product specifically designed to handle the unexpected. I've been running my own business for more than a decade. I've been in rooms with accountants, tax attorneys, and institutional portfolio managers who explain to me how money actually moves at the professional level, not in textbooks, in practice. In the specific decisions that get made when the incentives are clear. The thing I took away from all of those rooms, Every default option in every financial product is designed first for the convenience of the provider and second for the optimization of the investor. The default fund allocation is the one easiest for the plan administrator to justify. The default contribution rate is the one that generates the fewest HR complaints. The default retirement age assumption in every projection tool is the round number that produces the smoothest, most reassuring graph. It is not fraud. It is incentive alignment working exactly as designed. The incentives are just not aligned with your situation. The retirement crisis quietly building in this country is not primarily a savings crisis. People are saving. The 401k contributions are going in. The balances are rising. The quarterly statements look fine. The slow punctures are doing their work underneath invisible for 2 decades. And at 58 or 61, or the morning after the retirement party, the moment the math actually matters, the tire is flat. Not because people failed, because 4 specific, mechanical, calculable forces were working against them the entire time, and nobody with a financial incentive to explain those forces clearly had any particular reason to do so. Now you know what those forces are. You know their names. You know the math behind them. You know the 3 things that patch the holes. Lazy investing has built more genuine fortune than every cryptocurrency meme combined, not because doing nothing is smart. Because the lazy, boring, structurally sound version of investing low-cost index funds, inflation-adjusted projections, 3-bucket structure, fee surgery done once and left alone consistently, reliably, over every 3-0-year window ever measured, beats the hyperactive version. Vanguard's own research on what they call the advisor's alpha found that behavioral coaching simply stopping investors from making panic-driven decisions is worth up to 1.5% in first ender of color. Annualized returns, not from finding better stocks, from not selling in October 2008 and missing the recovery in March 2009. The value is in not reacting. The value is in having a structure that doesn't require you to react. Find the holes, patch them, then leave them patched.